In this video, I want to talk a little bit about the S&P again. This is the spider. We're looking at the stock market version today. And there's been a lot of talk about this market simply because, it's been having this big, huge run up, and then we got this little pullback in here. And the big question has always been, what's it going to do next? Is it going to rally or is it going to fall down harder? We've been doing a lot of analysis on this market. A lot of people have been concerned about it, talking to me about it. Many people have a lot of long positions in this market and are concerned how far this thing might fall back. That said, we did a video yesterday and talked a little bit about how you could get into this market with a married put. But I want to talk about a strategy I just put on in my account this morning. And I'm just selling some premium against the market and collecting some premium over time as a high probability trade. So I'm going to come in and show you how I did that. So the first thing we want to do is we just kind of want to notice, first and foremost, the previous trends. Now I've got my Elliott Waves zigzag Fibonacci tool on here, which is counting and projecting the projections, the retracements, and then giving us the legs of the Elliott wave up in here. Now, will this market go higher? It's anybody's guess. Will it fall and come way back down here into this lower region? It certainly could. The markets can do anything, as you can look back in time and you can see the different reoccurring patterns, and we can just anticipate that the market will have a tendency to repeat the patterns that it's done in the past. So looking at these patterns, you can see where the bulls and bears has come in and switched over each time. This market's had a good fall. So if we just look at the past, there is some additional downside potential on this market. But there's also got to be some, strong fundamental reasons why the market might fall. Now, we've got some things going on newsworthy-wise that could cause this market to fall. Some people would say that the newsworthy stuff that's out there could cause the market to rally and rise. One of the big things that's on everybody's minds is the impeachment of Donald Trump. Will that cause the market to fall, or will it cause the market to rise? Well, it really depends on which side of the market you're on and which side of the story you're on. So let's come in here and just do this from a technical standpoint and the opportunity that's available for us when the market gets into this overextended upper reach level. Mostly we're just kind of looking for the market to go sideways in this type of a strategy or have some small moves and not really get crazy like we did back here. So let's come in here, and the first thing I want to do is just draw the Fibonacci ruler in here, and we're just going to draw the Fibonacci ruler from the low to the high. So we're going to just identify the trend in there and look at it from a retracement standpoint. Now remember, this is the Fibonacci ruler that's gone from A to B, and we're looking for it to come back into the Fibonacci sweet spot. If it comes back all the way into this region here, this would be a nice place to be a buyer, and we would look for a next long position, right? So just giving a little idea of kind of what we could anticipate. If the market doesn't make it all the way back into this sweet spot and just comes down and starts to rally once again, you can look at my video that we did yesterday on a married put on here where you can get in and have a soft stop for a long position and protect yourself to the downside in case the market does want to rally and be in long with some shares. But how can we take advantage of this with a high probability trade and just pick up some premium? And this is what I've done in my account, and I wanted to share that with you today. So we're going to come in here and I'm going to remove these projections to the long side. Actually, we can just leave those in there, and let's go ahead and clean up the screen a little bit. I'm going to come in here and turn on my last Fibonacci number. You notice I right click on the Fibonacci tool and I can turn on these lines. I've got 78.6 in here, and I'm going to turn on this last 78.6 line down in here. This is a pretty low probability. What's the chances of the market falling down into this region? It's not that it can, it certainly can, but that would be quite a drop in the market. And time-wise, how long would it take for it to do that? It did it very quickly here. It did it very quickly back here. So there is some risk to this, but we need a little risk on our side to make it profitable to put on these positions. So there are some opportunities in here. You can see in the last 3 times that this has occurred that the market has dropped quite significantly down into this region. So let's come in here, and that's what people are afraid of, and that's what we're going to capitalize on. All right, we're going to capitalize on the fact of people's fears that the market's going to crash and fall, but then we're going to take the other side and we're going to say we don't think it's going to crash that far. Okay, it's not going to come back all that way, and certainly not within a short amount of time. So we're going to come in here, and I'm going to come in and start placing some options on the screen. And we're just going to do a little math calculation here, and you can see the profit reward potential of putting some options on here and selling and taking some premium. So the first thing I want to do is I want to identify that 78.6% level, and we're going to come in here with an option. We're going to sell a put, all right? So we're going to sell a put right at that level, and that's going to collect us some premium. And you can see over here that's going to be receive $55. And that's going to be in the next 19 days. Now, I put 19 days in here because, as you know, those of you who have been following me, I like to sell what I call a teenager. Sell a teenager. It sounds wonderful. Sell your teenager. but sell a teenager when it comes to selling options. We're selling something that's less than 20 days. So this is the perfect opportunity right here. We got a 19-day option. And at 19 days, the reason we like to sell the teenagers is because that's when the market time decay starts to drop off very quickly, or theta as we call it in the Greeks. So as theta starts to decay very quickly towards the end of the expiration, it's very difficult to catch up with the market in intrinsic value. Intrinsic value has to move quite quickly to outperform theta or outperform the time decay. So we're going to come down here within 19 days, and this is where we like to start selling these options. It gives us enough time that the market has time to perform for us, and that's good. And it also puts enough money in here to make it worthwhile. Now you say $55. Well, is that really worth it? Well, it's $55 in 19 days for a single option, and you can obviously double up or triple up or put 10 or 20 or 30 or 50 of these on here, depending on your risk tolerance. But nonetheless, we're just going to do, I'm going to start with one, and then I'll show you what I did with mine. I actually did 3. So we're going to come in here. I like to trade in quantities of 3, as you know. 3s are the magic number when it comes to the financial markets. So we're going to come in here, and this market would have to drop all the way down to here by that purple line. And we got a weekend involved here, so it would have to drop really quite significantly all the way down to this level for me not to get my $55. Okay, and that's 19 days. You're like, well, yeah, I'm gonna wait 19 days to get $55. Well, it's a high probability trade. Let's come down and take a look at this from a probability standpoint. We're going to slide down here on the options chain. You'll notice that I've got 19 days selected down here. And this is the option chain for the S&P, and we're going to slide all the way down until we see our marker. So that's our marker right there, as you can see, sitting at that 76.8 level, that this market has a probability of being touched only 4%. 5% right in there. Okay, probability of being out of the money is 92%. So you got a 92% chance that this thing, mathematically speaking, is not going to be touched or in the money. So that's a pretty high probability in your favor that you're going to make your $55 by that purple line by expiration. So you can say, well, I'm willing to take a little bit bigger risk than that, Lan. 92%, but that's only, $55. Let's see if I can get a little bit more money than that. Okay, well, let's come in and do one a little bit higher. And let's come in and we're just going to drop this in here. We're going to put 2 of them on the screen. We're going to say sell a put, and we're going to do one at 61.8. That's our Fibonacci golden ratio, right? So we're going to drop one in there at 61.8. Now that 61.8, as we see down here, has a probability of 12%. So 12% being in the money, 87% of being out of the money. So you got an 87% chance of that thing being out of the money. We oftentimes like to be at least to the 80%. So we can actually watch this. We can grab this right here, and we can just drag it up to 80% right there on the table, and it moves that order on our screen. That's a pretty neat little trick that we can do here in Track and Trade. You can just kind of move these around down here in the options chain as well as up on the screen. And you can see that now you're at the 80% level, but the 80% level is right here at the 50% retracement level. And for that market to come in and make that 50% retracement, it would only have to fall back. That's 100 shares. So that would have to fall back. Well, let's come in here and just for fun, let's change that over to a percent return on margin. That'd have to drop about a 4%, 3.5% in the market by that purple line for that to not make money. And you're going to have receive $151. So you're going to have to play with this and determine where your risk tolerance is and how close to the market you want to be with these options. Now, for me, when I put mine on, I put one on at the 61.8% level, and you can see again down here that's going to be a probability of being out of the money at 87%. I also came in and I put another one in. Let's put one in. We're going to sell a put. I'm going to put one in at 78.6. This is what I did. I put one in at 78.6. I put one in at 61.8. Now you're going to see down here that this trade premium credit is only $149. Look at our calculator. Our calculator down here says that we're going to make in 19 days $150 with these 2 options that we've sold. And again, we've got one that's sitting here at a probability of being out of the money 87%, being in the money 11%. We got the other one here at 92%, high probability of not being touched by that purple line. And we're going to make $149 doing that. But look, we're going to risk $12,000. We could have a $12,000 loss on here. So let's cut that loss short. We're going to come in here and we're going to buy a put. down here, and we're going to protect ourselves. Now I'm going to put this all the way down here, and mostly it's just to reduce our margin requirement. You notice that there's a margin requirement of there of $12,000. So let's reduce our margin by buying a put in here, and we're going to actually do 2 of those because we got 2 that we've sold, right? So now notice that drops that all the way from $12,000 down to a buying power reduction of $1,600. That's significantly better. And what did we have to pay to do that? We had to pay in here about $62 to pick up that additional protection to the downside. Now, the likelihood of that having to be hit again is 1.7%. So you got a 95.7% chance that thing's not going to be hit anyway. It's really there just to reduce our buying power reduction, our margin requirement. So we're really playing the odds in here. What we're doing is we're looking for this market to stay up above this red line. That's really the name of the game right here. We want it to stay above this red line by that purple line. So anything above that red line by the purple line is going to be good for us, and we'll collect our entire premium. If it comes down and starts dropping down below this red line, we're going to be in trouble, and we're going to start digging into our reserves here, and we're going to have to pay a little bit of margin. So we don't want this market to fall all the way down here, but that's the name of the game that we're playing right here. We want it to stay inside this box by that purple line. That's really how it works. All right. All right, now the other thing that I did is I said, well, $87 in 19 days isn't really enough to make it worth my while, and I've got a real high probability down here. So I can come in here and I can increase the value. So I'm going to increase the value. I brought mine up to 3. This one we're going to bring up to 3. This one we have to double, so we have to bring up to 4. Actually 6, right? So we have to bring that one up to 6. Now we're going to have a total premium credit of $261 in 19 days, a margin requirement of $5,100, a buying power reduction. Max loss is $4,800. So if this market actually crashes and comes all the way down into this region down in here, we're going to start losing money. And if it goes all the way down to that green line, we're going to lose our max of $4,800. All right, $4,846. So this is the way this is playing out for us. If you have a little bit higher risk tolerance and you believe this market's going to either rally or stay up here in this upper region and not drop all the way down to that red line before that purple line, go ahead and crank it up. Go up to 5, go up to 6, go up to 7, go up to 8, whatever you feel comfortable with as your probability rating. Now let me show you one more thing just real quick before we run off, because there's a feature in the track and trade software that I think is really cool. We can come in here and I'm going to hold down the control key just like I would with any Microsoft product, and I'm going to hit multiple selections, and I'm going to select these 3 orders right in here, and now I can drag those up and down on the screen, and watch on the screen. You'll notice that the orders are moving up and down as well, so I can move those to a higher or a lower probability state, all 3 at the same time, with just one simple drag of the mouse, and I can put those where I might want those. And you can watch as you release the mouse, it's going to recalculate over here, and your math calculation is going to recalculate. Now at this level, we've got this thing moved up, and you can see the premium credit is $360 with a buying power reduction of $4,700. So again, you can drag those, hold down your control key, and you can drag those to the new location. You can just watch it on the screen, and you can line those up with your Fibonacci lines on the screen, and that's right where I want mine. And we're going to go ahead and we're going to hit place order, and we're going to place order into the market, fill those positions, and we have our trade. All right, guys, that's just a quick example of how you can take advantage of the S&P 500 using options.